Yeah, welcome. Francis Longstaff here. I'm at home, like everybody else, out in the outskirts of Santa Barbara. Live out in the country, a couple hours away from UCLA, but it's a good place to sort of be weathering the storm. So hope everybody's doing well. One of the nice things about the country is it's very peaceful and kind of picturesque. But I'm glad to be here because, like the other night, I went for a walk with my wife around our block, around sunset, beautiful scenery, mountains, the chaparral, very nice. But like we were walking down the street and suddenly there was this buzzing sound and just reflexes kicked in and I jumped right over a rattlesnake. Another step, I'd have spit on him. So I'm glad to be here rather than in the emergency room. So anyway, grateful to have the chance to talk about our paper. This is with co-author Matthias Fleckenstein at University of Delaware, and about the valuation of derivatives. So let me just kind of start with a couple of quotes. A good quote here by Darrell Duffy talking about balance sheet space being treated like expensive real estate. And we've heard a lot about balance sheet costs. Izzy Kaminska, this quote about bankers blaming tensions in the repo world on the cost of renting out balance sheets. So this is kind of what this paper is about. And I think we can start off with kind of raising just a really fundamental question here, like what interest rate should we be using in the Black-Scholes model or in derivatives valuation here? We all know that in theory, the financing rate for derivative contracts in the risk-neutral world should be the riskless interest rate. So we tell students it should be, like the return or the rate on a short-term Treasury bill or something like that. But in reality, one of the long-standing puzzles in derivatives pricing is that the implicit funding rates or the implied funding rates for derivatives often diverge from the actual rates that we see in the cash markets. Now, why is this? Well, some clues in the literature. The recent literature we know on intermediary asset pricing is providing evidence that balance sheet constraints or capital constraints may play a central role in explaining the pricing of assets in other markets. So this paper is kind of asking the reverse question. Is it possible that this might explain mispricing? Does the cost of renting balance sheet space from financial intermediaries maybe impact or lead to the relative mispricing of derivative contracts relative to the underlying securities? This is kind of a relevant question here because derivatives may be a little bit unique in that they require a much more intensive use of balance sheet space than maybe cash securities. Since, think about the intermediary that's providing the other side of the trade. They have to hold the underlying security as a hedge. Some intermediary has to. But they also then take the other side of the derivatives transaction. And so they kind of have a double whammy here. They may face additional costs and constraints. So derivatives may be particularly sensitive to the use of balance sheet space. Now, I have to emphasize that we, of course, are not the first to suggest that balance sheet issues may explain mispricing. There's kind of like a well-known paper, Tepper and Verdellen right now, that's a very nice paper talking about violations of covered interest rate parity. And it's cash versus forward markets. So again, it's a derivatives versus cash market pair. And they have very dramatic evidence that it's being driven by intermediary balance sheet issues. So what this paper does is our contribution really is to show that those Tepper, Verdellen results may really just be the tip of the iceberg. In fact, in this paper, I think we try to show that the cost of renting balance sheet space may also help explain much larger examples of mispricing in much larger derivative markets over much longer periods than have been previously documented. So here's the intuition of the paper in a nutshell. So imagine we have an investor who wants to take directional exposure to some asset, wants to go long or short something. Now that investor has two choices with the birth of derivatives markets. The investor can either own the security outright by purchasing it in the cash market and placing it on its own balance sheet, or the investor can take some sort of a synthetic position in the security for, let's say, doing something like a total return swap or a forward contract or some sort of other type of swap. So there are a couple of choices here. Now, to facilitate the transaction, the second transaction, however, some intermediary somewhere, there's a chain maybe of intermediaries, but somebody somewhere has to place the security and the derivative contract on its balance sheet, and then, you know, incur whatever resulting balance sheet usage costs are associated with that. In this case, the investor then, who's doing it synthetically, is essentially renting the security from an intermediary in the derivatives market. And in equilibrium, you know, the implied funding rate, the return the intermediary gets from this, has to equal the financing rate in the cash market plus any other balance sheet usage costs that the intermediary has to incur. You know, it's the difference between buying a house and renting a house. You know, if you rent the house or apartment, you don't directly pay the property taxes, but it's got to be added into the rental cost. Otherwise, it's just not going to work. So when I talk about balance sheet usage costs, I'm going to use this kind of generically. I mean a pretty broad set of things. It's not just post-financial crisis capital regulation stuff like Basel III or Dodd-Frank or what I mean, you know, those are examples of balance sheet usage cost or capital and leverage constraints. But we also, you know, we're talking about leverage requirements like the SLR ratios or liquidity requirements, the LCR ratio. There's now margin and collateral requirements, clearing, etc. But a point that Daryl has made, which is a good one, is that these aren't the only sort of balance sheet usage costs. He talks about, you know, in many cases, some of these problems are dealing with frictions that have nothing to do with regulatory capital requirements. And a recent paper, Anderson, Duffy, and Song, sort of focuses on debt overhang. It's a nice Journal of Finance paper there where they're kind of showing a kind of counterintuitive example where buying a Treasury bill is actually a negative NPV project simply because it's going to have an adverse impact on the current shareholders. So debt overhang costs have been around perhaps much longer than capital regulation, post-crisis capital regulation. Johannes and Sundaresan talked about the cost of collateralizing liabilities in kind of very, very pioneering paper. But there are a lot of other types of constraints, VAR constraints, cost of funding illiquidity. So when I'm talking about balance sheet constraints, I'm not just thinking about Dodd-Frank or Basel III, you know, since the financial crisis. These are things that might actually go back decades, and that's kind of the evidence that we find. So what we're going to do here to study the relation between balance sheet usage costs and derivatives, we're going to focus first on the interest rate futures market, because we basically want to go to the market where there's probably the largest demand for notional balance sheet space. I used to think actually that the swaps market were the largest markets, but now actually looking at the data, it turns out that the interest rate futures markets are really by a long ways the largest, at least in terms of transaction volume, the largest markets we've got. It's like $5 trillion daily versus like maybe $2 trillion for interest rate swaps. And the Forex forwards that do Tepper and Verdella look at, it's like under $1 trillion. But you know, if you want to go look for the place where you're using up the most balance sheet, it's probably logical to first look at the interest rate futures market. That's where we start, but we're going to also look at some of the other markets. So the idea here is really simple. We're going to basically measure the basis between T-notes and T-note futures. And so we can directly observe what the financing rate is, the repo rate is for Treasury, 5-year Treasury notes. And then we go to the 5-year Treasury note futures markets and we can back out what we call the implied repo rate. So we're just going to simply be looking at repo rate versus implied repo rates. And, you know, in theory, without any frictions, those two things should be the same. But if you're renting balance sheet space via going long T-notes synthetically in the futures market, then that implied repo rate should reflect the incremental cost of those balance sheet usages. So what's nice about this is that we have almost a 30-year period where we can study this. So it goes way before the financial crisis. And that's the cash derivatives pair we're going to study first. But then we're going to also look at some other markets where you've got cash derivative pairs, like the TIPS, swaps, agency mortgage-backed securities, etc. So to give you a quick thumbnail of the results, we're going to show that there's a large funding basis. So let's call that, we could call that an arbitrage, a deviation from the law of one price, whatever you want to call it, liquidity. A lot of names get thrown here, but it's basically there's a pricing difference between the cash and the derivatives market. Our referee liked the name funding basis, so that's what we got. So we have documented a large funding basis over about a 30-year period. It ends up being about 60 basis points, but with gusts up to about 200 basis points during crises like the LTCM crisis or the Asian crisis, the financial crisis, and actually surprisingly during the Treasury buyback programs of the early 2000s. It turns out that this basis, this difference between cash and derivatives markets is at least as large during the 1990s as it is during the post-crisis period. So it's clear that post-crisis capital regulation can't fully explain the mispricing of derivatives relative to underlying securities. Now, we're conjecturing that this is due perhaps to balance sheet cost, and of course we need to now show the evidence. And so we document here, and I'll show you a series of analyses where we show that this funding basis seems to be related to things that are related to balance sheet costs. There's quarterly calendar effects, there's a turn of the year premium. It's going to be strongly related to things like debt overhang variables or the amount of capital that intermediaries are required to hold. So there's certainly going to be the evidence that this is at least linked to kind of what the story suggests. And then we're going to show that this is kind of a common factor in other situations where we're observing mispricing or deviations between cash and market derivatives markets in terms of pricing. Okay, so quick, where does this fit in the literature? Well, as I mentioned, there's a lot of papers that I've looked at the implied funding rates coming from the derivative markets and comparing them with actual financing rates. A lot of papers on that. Number of recent ones as well. There's extensive literature on intermediary asset pricing, rapidly growing, way more than I could sort of cite here. So that's kind of the quick overview. And so maybe I should stop for a minute, see if there are any questions at this point, and before starting to go through the paper a little more systematically.
Well, Francis, there aren't any questions in the chat yet, but I have a simple one. Do you
Sure.
have to deal with it? Do you have to address the cheapest to deliver option in the note futures?
Absolutely. So yeah, we do that. So we pick the 5-year note futures because they're the most liquid, and the CTD option is really pretty small. But in the paper and in the appendix, we've got kind of a simple 3-factor model where we go through and explicitly strip out the CTD. It's usually very, very small, but we do have to address it. Absolutely. Okay. Well, then let me proceed here. So we have in the paper, we've got a model. I'm not going to actually take the time to go through it. It's a simple model, and we'll have some details on that in a bit. But basically, we have a model where we've got what's the impact on the implied repo rate of the haircut that's involved, the margins on the collateral, debt overhang costs, etc. But bottom line, the idea here is the funding basis is just going to be the implied repo rate minus the actual repo rate. So the implied repo rate, again, we have to deal with the CTD, as I mentioned. That's an important thing. But then it's pretty simple to calculate this thing. So we are going to argue that the funding basis can be interpreted as the cost of renting balance sheet space. But again, I have to sort of demonstrate that. That's our claim, but we have to back that up. Data here, we're going to be using daily 5-year U.S. Treasury note futures. We've got prices on the Treasury notes themselves, all coming up from the Bloomberg system. We're also able to get a set of special collateral repo rates. This is going to be very important because one of the usually we think about balance sheet costs, but sometimes the putting something on your balance sheet can be a bit of a benefit if it's trading special in the repo market and you can actually finance at very low rates. So there's kind of sometimes a benefit to putting stuff on balance sheet. And that shows up in that sometimes you can finance the cash security at very low rates, whereas the implied repo rate, where you don't get special treatment, you're going to be paying a lot more. So that actually will magnify the impact of the balance sheet cost. The difference between the financing of cash securities and then synthetic securities it'll be a much larger spread when the cash security is tight in the special repo market and financing at very low or even sometimes negative rates. Then we also have the general collateral repo rates, and that gives the data that we are going to be using. So just to give you a quick overview here, these are all the futures contracts we've got going back to 1991 through the end of 2018. So I guess that's close to 27, 28 years, something like that. A lot of data. We've got, okay, so let's just cut to the chase here. This is what the picture looks like over about 30 years. The red line is the implied repo rate, which we're inferring out of the Treasury note futures market. And then the blue line is the repo rate, which is often special for the 5-year Treasury note. So the note that actually corresponds to basically the cheapest to deliver a note in the contract. And as you can, just eyeballing this, you'll see that the blue line is almost always below the red line, although it trades through. It's real data, so there's noise in there and bouncing up and down. But you can see that there's some big downward spikes in the repo rate, and that's going to be associated. A lot of that happens around the Treasury buybacks of the early 2000s. So what does this spread look like? This is this funding basis. In a world without any frictions, in a world in which derivatives pricing is exactly spanned by the cash securities, this should be zero. This is kind of, we can call this mispricing. Maybe you could call it illiquidity. Whatever your favorite name is for this deviation from the law of one price. We're going to argue that it's not an arbitrage. It really is just reflecting the cost of having stuff on balance sheet. But you can see that most of the time it's positive. There's some spikes here and there, and a lot of these spikes seem to be associated with events. We just put in a bunch of arrows here to illustrate different situations here. Financial crisis, whatnot, but a lot of times there's variation, but it's generally fairly positive, and it's hovering around between 0 and 100 basis points. So, quick summary statistics for this funding basis. It's about 60 basis points on average. It's positive like 83% of the time. There's negative observations here. Hard to explain, but they're kind of rare. But the median is about 44 basis points. So it's very persistent, very positive. And the point is here that this is, it happens long before the capital regulation of the 2008, 2009 era, right? A lot of this literature seems like suddenly capital constraints and regulatory capital issues suddenly entered into the world starting after the financial crisis of 2008. No, there were capital constraints and frictions and costs of using your balance sheet long before Dodd-Frank and Basel III. And we're arguing that this is evidence that we've always had sort of these kind of constraints. So, all right, so let's talk a little bit about the properties of the funding basis. I want to sort of argue that we can link it to some of these balance sheet usage costs I've been conjecturing. So, as I mentioned, it's about 60 basis point on average. With our simple model, we can kind of decompose this into pieces. There's a part that's related to the haircut, which is H, and that's also going to be multiplied by the difference between the unsecured funding rate for the intermediary minus the secured funding rate, which is essentially the repo rate. If they have to cover their haircuts or their margin by raising capital and they can't do it on a secured basis, they have an incremental funding cost here. So the margins, the haircuts get financed. There's the debt overhang where they have to put in extra capital. That in our model, those two things are kind of lumped together. But what we do is we use this recent paper by Anderson, Duffy, and Song, where they provide kind of a simple model of what the debt overhang costs are. What is the impact on existing shareholders of putting stuff on balance sheet? And they provide a simple model. So what I do is I decompose that third component into the part that's debt overhang, and then that lets us back out as a residual the implied value of capital regulation. So the first thing we do here is kind of decompose this funding basis into four components. Admittedly, the capital regulation component is indirect. It's implied. It's not, it is what it is. So it turns out that the haircut component during this period, the full sample, and then we break it between pre-crisis and post-crisis, it's pretty small. It's not a big deal, even though it seems to get a lot of attention in the literature. It's kind of tiny. Similarly with the margin component, the debt overhang component, using the Anderson, Duffy, and Song model, it actually is pretty significant pre-crisis because interest rates were much higher. The difference between unsecured debt costs and secured debt costs was higher. So it was about 60 basis points pre-crisis. It's since the financial crisis, it's been quite a bit lower because spreads are tighter. But again, it's about 45 basis points over the full sample. The implied capital regulation component is interesting. It's actually close to zero or slightly negative pre-crisis, but post-crisis, it's on the increases to about 32 basis points. And so what we get is this phenomenon that the total funding basis is about the same number, both pre-crisis, post-crisis, as over the entire period. And so over a 30-year period, we've always had these balance sheet costs. It looks like the composition has changed, that the debt overhang component has shrunk, but at the same time, the capital regulation component has become more important. And so we want to sort of explore the variation here. Here's a picture of what these components look like. The haircut and margin components, we lump them together because they're kind of small, and they've actually become very small in the last, since the crisis, as the funding costs or difference between unsecured and secured financing rates have shrunk. The debt overhang component was very, very large in the pre-crisis period, and it kind of has all these spikes going up around 2000 to 2002. We'll argue that that's related to the Treasury buyback programs. It's kind of shrunk because the spreads aren't as high, but at the same time, we see that the implied capital regulation component has become more consistently positive in a post-crisis period. Before that, it was kind of wandering up and down, plus and minus, slightly negative on average. So anyway, some decomposition of this funding basis. To show you some anecdotal evidence, we just picked a couple of these crisis periods. There's the Asian crisis of '97. Red line is the implied repo, blue line is the actual repo. And in a crisis, sometimes we see that the Treasury notes go on special. Suddenly there's maybe a bit of a flight to quality. People want to hold cash. And so that creates a spread, a difference between the cash and the derivatives markets. And again, a lot of these things can be linked to special events. LTCM, long-term capital here. This is a interesting summer back there in '98, and you can see, as we get into October, November '98, that there's a real widening, a major widening between the implied repo and the actual repo rate. A lot of it is just that the repo rate shrinks relative to the implied financing rate in the synthetics market. But again, there's spikes that are kind of hard to explain, but interesting things moving there. And finally, the Treasury buyback program, starting back in like 99, going to 2002. We had lots of situations. Believe it or not, we thought we were going to pay off the Treasury debt back in the Clinton administration, but we weren't going to have any Treasury debt anymore, Treasury bonds to look at. And, you know, sometimes the cash collateral got very tight in the special repo market. We see all these spikes, especially around buybacks and then sometimes auctions. But over time, this was a major source of some of the spikes that we saw in the difference between the financing rate in the derivatives market and the financing rate in the cash market. So just to put this into perspective with some of the other types of bases or mispricing or ARBs or liquidity shocks, whatever you call them, we find about a 60 basis point funding basis here. Tepper and Verdellen, again, they're looking at the difference between rates implied in the FX forward market versus cash rates. They find numbers that, at least in the post-crisis period, around 24 basis points, lower pre-crisis. Other papers like Song and Zhu have a nice paper where they're looking at the dollar roll. So we're looking at the cost of financing agency mortgage-backed securities, first in the cash market, and then also synthetically through these dollar rolls, which are basically just pairs of forward contracts, TBA contracts. They come up with numbers that are kind of on the same order of magnitude, about 55 basis points post-crisis, 30, 40 basis points pre-crisis. Paper that I have with Matthias and Hanno, TIPS Treasury basis. You can view that paper as kind of, we're looking at the difference between TIPS and Treasuries, as kind of that's a difference between cash rates, and comparing them with inflation swaps. So that's a derivatives market. And we're coming up, we come up with numbers around 40 to 50 basis points. So a lot of these sort of cash versus synthetics or derivatives are coming up with numbers that are kind of in the same order of magnitude, you know, depends on time period, of course, but there seems to be some commonality there, at least in the magnitudes. Okay, so here's the part where I'm going to try to argue that this is not just some sort of, you know, just the number we pulled out of the air. This actually has something to do with balance sheet usage costs. So the first analysis that we're going to do here is we are going to follow Tepper and Verdellen and see if this basis has anything to do with some exogenous event like the end of a quarter or the end of the year. You know, in theory, you know, if it's related to balance sheets, and if intermediaries really do care about window dressing their balance sheets at the end of the year, which they certainly do. I remember when I was at Solomon in the mid-90s, we spent a lot of time at the end of every quarter making sure that our balance sheet leverage looked lower. I think typically during a quarter, we might go up to 50 to 60 to 1, but we would kind of engineer our balance sheet at the end of the quarter so it was down to 30 to 1. So institutions do worry about how their reports look. So here we just do a simple analysis where we're just going to look at the funding basis at the end of quarters or at the end of the specific quarters. You know, we have to put in all sorts of fixed effects to control for, you know, day of the week, year, etc. But bottom line is we get results similar to Tepper and Verdellen, that they're actually there's kind of an end of the quarter effect that's fairly significant. And so, you know, there'd be no reason for this to occur if the funding basis had nothing to do with balance sheet usage costs. So that's one bit of evidence. The problem, though, with just looking at quarter ends is that you're kind of limited to quarter ends. So we thought it would be great to have maybe a more continuous measure of how concerned intermediaries are about using their balance sheets. We came up with this idea. We're looking at something that we're going to call the turn of the year premium and Eurodollar futures prices. Now, you probably know Eurodollar futures contracts, you can think of them as just futures contracts settling to 3-month LIBOR. For example, if the December expiration for a Eurodollar futures contract expires like near the end of December, and then it settles on the basis of what 3-month LIBOR is on the settlement date, on the expiration date of the contract. Now, a 3-month LIBOR loan that is determined at the end of December is for a 3-month loan that is going to, if a bank takes that 3-month loan, they're going to have that on their balance sheet over the year end. In contrast, if the rate is set in, let's say, March or June or September, the 3-month LIBOR loan does not go over the end of a year. And so what's well known is that banks are reluctant to keep things on their balance sheet over the year end. And so when they're quoting rates for LIBOR at the end of the year that goes over the year end, they tend to charge a little bit more or have to pay a little bit more. And since Eurodollar futures are, as we know, futures are just the risk neutral expectation of the settlement amount, the seasonal variation in expected LIBOR shows up in the Eurodollar futures price. So what we have here is back on January 3rd, 1994, Eurodollar futures contracts go out at least quarterly for about 10 years. And so you have like 40 contracts. And what we're seeing is that the ones that settle or expire in December just have, a higher value than all of the others because they're for a LIBOR loan that goes over the end of the year. And so we can take a look at the difference between the Eurodollar futures price for a December expiration relative, let's say, to September and March expiration. And that difference gives us a continuous market-determined measure of how concerned institutions are about having stuff on their balance sheet at year end. So it just gives us a way of measuring kind of the reluctance to put stuff on balance sheet. So we're going to kind of, again, take the difference. We're going to look at the September and the March expirations, compare it to the December expiration, the prices, and that's what we call our turn of the year premium as a way of measuring the reluctance to put things on balance sheet. And that's an interesting index. It's continuous. We can look at it. It's kind of gone down dramatically over time, surprisingly, but we're going to use that as a measure of, as a proxy or an instrument for balance sheet costs. So simple analysis here. We just take the changes in the funding basis, regress it. We're going to put regress it on its lag value just to control for time series or stale trading effects. And then we have the turn of the year premium, and yeah, it shows up very significantly. This is from a different market, the Eurodollar futures market. Again, yes, it's an interest rate futures market, but it's a totally different market than the Treasury note futures market. Yet we're finding that this funding basis in the T-note futures market seems to be positively and significantly related to this turn of the year premium that we argue is directly related to reluctance to put things on balance sheet. So that's another piece of information. We then take a look at whether there might be some real effects, and in theory, if banks are, if the cost of putting things on balance sheet go up, banks should be doing less of it. So we take a look here and say, can we see some effects in aggregate broker-dealer treasury holdings and financial assets? Is it related to our proxies that we hope are trying to capture the changes in the cost of using your balance sheet? So we regress, for example, broker-dealer treasury holdings, changes in those holdings on the changes in the turn of the year premium and in the funding basis. And, while it's not super strong evidence, we do find that, that when the funding basis goes up, at least one of its lags, that we do see that broker dealers tend to hold a little less Treasury and agency bonds on their balance sheet. This is all Federal Reserve flow of funds data. Similarly with total financial assets, that when the funding basis goes up, or that in this case, the second lag turn of the year premium goes up, we're seeing a decline in total financial assets. So this, again, it's circumstantial evidence. It's definitely not a causal argument. This is not a diff and diff analysis of exogenous shock. Nevertheless, at least it's consistent with the story that if something is more costly to have on balance sheet, broker dealers are going to have less of it on their balance sheet. So at least it kind of goes in the right direction there. The next thing we do is focus a little bit more on the debt overhang story, Anderson, Duffy, and Song paper. And the idea is that if the cost of debt overhang, which are largely related to the difference between unsecured financing rates and secured financing rates, if that goes up, then that should have, that should be a big component of what we call the funding basis here. And so we throw in some variables that are ostensibly, controlling or trying to capture, what drives the unsecured cost of financing. We kind of, it's ambiguous as whether they're debt constrained or equity constrained, but we just use some variables that have been suggested in the literature, put them in different credit spreads here. Bottom line is that there seems to be a lot of support for this debt overhang theory here, that like a stock return goes up, so that maybe the cost of equity capital is now going down. We see that the funding basis shrinks. We see, for example, that if spreads between investment grade financials or AAA, BBB corporates, when those go up, there's a significant effect that the funding basis goes up. So again, it's evidence that's consistent with this debt overhang story, which is, a model of one component of the balance sheet cost and intermediaries face. So the debt overhang story actually gets a lot of support. And this is an important story because it applies not just in the post-capital regulation era, debt of Dodd-Frank, et cetera. This is something that might have been around for decades. There's always been a cost of using balance sheet. Another way of approaching this also, and this now focuses more on the capital regulation story, what we're going to do is regress changes in the funding basis on changes in various regulatory capital ratios that have become kind of important. The idea here, we're making an assumption, admittedly. We're saying that, okay, if a bank increases their capital ratio, they're doing it because they're kind of constrained to do that. Banks have strong incentives to leverage, and when they're increasing their capital ratios, it must be because they're kind of being forced to do it, right? Is the implicit assumption. I think it's a reasonable assumption, but bear in mind, we are making that assumption. So we're going to basically say, okay, if the capital ratio goes up, the tier 1 capital ratio goes up, the risk-weighted assets, then it's because they're more constrained, and therefore the funding basis should go up. So in that interpretation, increases in capital ratios should be associated with an increase in the funding basis. And that's kind of supported strongly by the data, surprisingly. Again, this is quarterly data, but we look at the change in the tier 1 regulatory ratio, what's known as the core ratio, the equity ratio, or total capital ratio, the various ratios that have kind of shown up in Basel III or the Dodd-Frank framework. And we're getting support from the data that this funding basis seems to go up when banks are kind of increasing their capital ratios, which again we interpret as they're kind of being forced to do that. They're more constrained, and it impacts their costs. So again, the funding basis seems to be compatible with that hypothesis. Okay, well, let me move on here in the interest of time to talk about some other markets. If this is really due to balance sheet constraints, if it's not about the derivative, it's about the dealers, then the dealer constraints should be a common factor impacting pricing across derivatives markets. It's not the security or the package of cash flows, it's the dealer that is what's the common factor here. And so we wanted to just see, okay, do we see evidence that these sort of effects are showing up in other markets where we might, in particular, pairs between cash and derivative securities. And one of the obvious ones here is the interest rate market. We looked at interest rate swap spreads. As we all know, receiving fixed in an interest rate swap is effectively a synthetic position in a fixed rate bond. And so the difference between, the interest rate swap spread is the difference between a derivative and a cash security. And if it's being driven, if part of that interest rate swap spread has something to do with balance sheet usage, we should see the effects of that in the movements of interest rate swap spreads. So what we do here is just simply look at changes in swap spreads, regress it on changes in the funding basis and on the turn of the year premium. Here, admittedly, the funding basis that we found doesn't seem to be all that significant. But instead, the turn of the year premium is this more generic Eurodollar market-based measure. That seems to be consistently positively related to at least the contemporaneous change in interest rate swap spreads. So that seems to get some support. There seems to be this common factor, this proxy for the turn of the year cost of balance sheet usage seems to be showing up also in interest rate swap spreads. And finally, we take a look at some of the major, bases that have been documented in other markets. Again, there's, probably dozens of these papers now documenting these sort of differences, but these are some of the largest markets. And we want to see whether there's some commonality here in like the impact of the turn of the year premium. Covered interest rate parity, again, going back to the new Tepper-Verdellen paper. And there's evidence, that changes in that covered interest rate parity basis are linked positively to the turn of the year premium. So supportive of the story that, again, that it may be driven by balance sheet usage costs. The dollar roll paper by Song and Zhu, we're looking at their measure, and sure enough, it's related to positively and significantly to the turn of the year premium. Another one where it's cash versus synthetic is a CDS versus corporate bonds. And again, there's some evidence there. It's kind of the second lag. It's maybe not as direct as I'd like, but there seems to be some evidence there. And then finally, our Treasury tips arbitrage measure. Again, we find a positive relation there. So this is after controlling for the time series properties of dependent variable. We get a little bit of evidence for some of the funding basis, although the sign is not always the positive as we would have expected, but that could be the incremental effect. But bottom line is, again, this is circumstantial evidence. This is not causal in any way, shape, or form. But it does suggest that there is mispricing. Whenever we've documented mispricing between the underlying security and the derivatives, let's call that a basis, there's evidence that there seems to be some commonality there that might be related to these measures of balance sheet usage. This may ultimately be kind of an important factor in explaining why our derivatives models may be not always working perfectly. So, in conclusion, there's an extensive literature going back at least 30 years showing that the financing rate that you stick in a derivatives contract, or the implied funding rates that come out of these models at market prices, often diverge from the riskless rates observed in the cash markets. We've interpreted that as, either mispricing or arbitrage or liquidity. But the argument here is that that may actually not be an arbitrage. It may just simply be the cost of renting balance sheet space. That may help resolve this puzzle. So in some sense, it's not like a mispricing. It's just like an extra transaction cost. You want to take a position in the stock market, you can either buy the stock market or you can do it synthetically through a total return swap. But if you do it synthetically, you're going to have to pay for my balance sheet costs if I'm an intermediary providing intermediation for you. It's just like an extra transaction cost. We study the funding basis between the T-note futures and Treasury notes themselves. Hopefully I've been able to convince you that it's linked at least to the cost of balance sheet usage, in terms of like the quarterly effects or the turn of the year, Eurodollar futures premium. It seems to be present throughout the entire sample period and not just simply an artifact of post-crisis capital regulation. We find some evidence that it's linked to the way intermediaries are managing their balance sheet and the cost to them of placing additional assets on balance sheet. It's also related to the amount of capital financial intermediaries must hold. When they're more capital constrained, their balance sheet space is more precious and they charge for it. And that puts a wedge between cash and derivative prices. And finally, we show some evidence that these results extend to bases observed in other securities and other derivative synthetic pairs. So this suggests that our results may just simply be the tip of the iceberg, and that now we should think about exploring whether the effects of balance sheet rental costs are an important factor in any derivatives model. Going back to the original question, what interest rate should we stick into the Black-Scholes model? Well, it shouldn't necessarily be just the short-term, T-bill rate. It should be something that also captures the incremental balance sheet costs that the intermediaries are going to have to sort of deal with when they place things on their balance sheet. So, well, let me stop at that. I think we're just about at 50 minutes, but open this up for questions or comments or discussion.
So Francis, thanks very much. This is Neil again. I'll ask a couple of questions that were in the chat, but after I do that, I'll invite everyone else, I invite everyone else to unmute themselves and ask their questions via the microphone if they want to. But anyway, first question from Francois Cocoma. How should we think about the difference between having long and short positions on your balance sheet? And I assume he's thinking about the underlying asset, not the derivative.
Yeah, that's a good question. A lot of these, one of the problems with some of this capital regulation is that they don't seem to really distinguish between long and shorts. It's all painful. It has balance sheet costs, and it's a great question. I don't know that there's a lot of distinction that's being made. And so, but yeah, you'd have to kind of look at the specifics of the situation to see if there's differential costs from going long versus short.
Well, so let me ask a follow-up question, even though I don't know whether it's the one that Francois would have asked. Does it matter in your analysis? Does it show up in your analysis? I guess not.
Not really, not in our analysis. In our model, we just, it seems to work equally well long versus short. You'd have the same margins on the long and short side. The debt overhang costs pretty much are the same. So in our analysis, it didn't make a difference. But there may be other situations where going short is way more painful than going long. And we were also thinking here in terms of, the financing rate for putting the security on balance sheet. You get the special repo rate, but you probably won't see that in the reverse repo market. But yeah, it's a great question, and you kind of have to drill down. There's probably no generic one-size-fits-all answer. You'd have to look at the specifics here, and each market might be different.
Okay, and then from Alessio Soretto, I was wondering if we can think of the funding basis as a convenience yield, and if so, whether demand for the underlying might have a role when investors really want to hold the security.
Yeah, great question, Alessio. Yeah, I mentioned that people call this deviations from the law of one price, or an arbitrage, or mispricing, or liquidity. Another name is often the convenience yield. It's kind of, we see mispricing and we put different names on it depending on what you want to call it. But yeah, this has sometimes also been called a convenience yield. We're seeing also kind of in the safe asset literature, people are calling this kind of a safety premium. That's kind of that's more like cash versus cash, but you could call this a convenience yield. It's like if you rent an apartment versus buying a condo, you have the convenience of not having to own the security, but you pay up for it. So a convenience yield is another name for kind of the same phenomenon. Mathematically, it's just a difference between the financing rate and the cash and the derivatives market. Call it what you will, but convenience yield is just as good a name as any of the others.
Okay, and then from Steve Figluski, 2 questions. First, the level of this factor is remarkably constant over time, but its volatility seems to have gone way down after 2008. Why? And I guess I'll also ask the second question at the same time since they're related. With the Fed flooding the market with liquidity today, has that made the effect go down?
Okay, great questions. Yeah, Steve is right that I think it's more just a mathematical coincidence that the values of the funding basis are about the same post-crisis and pre-crisis. The composition has certainly changed, but I think what we've seen is that we've got more capital regulation post financial crisis of 2008, and that's been more stable. Whereas pre-crisis, we just saw a lot of much more movement in spreads over time. Since 2008, spreads have been actually pretty stable, and so I think that's just an artifact of that. So it would be interesting to see how this changes. So Steve is asking a great question, how it's all going to change. It's funny, we're still talking about the financial crisis of 2008. I think that just now went into the background somewhere. This is like, we have a new, much bigger financial crisis here, but it will be interesting to see what's going on. Certainly the aggressive use by the Fed of their balance sheet to kind of, now they're even buying corporates. They announced this week. So it'll be interesting to, we're gonna have a lot of data going forward. I don't know, Steve, it's a great question. I'd love to see the answer there, but it's going to be probably tougher for institutions to put a lot of stuff on balance sheet, and therefore they're going to charge extra for it. So I would not be surprised to see the bases in a lot of markets, cash versus derivatives, widen and stay wide for a while. I'll just go out on a limb and make that forecast, because I think the cost of using your balance sheet has gone up astronomically because of, we're going to have less capital and it's just more risk.
Okay, that's all the questions in the chat, but I'll once again invite everyone, if you have another question, to feel free to unmute your microphone and ask it orally.
Yeah, I got a couple of comments. Hello?
Yep.
Go ahead, I can hear you.
Yeah, hey, Francis, nice presentation. So 2 comments. The first one is you find that the haircut component and margin component is really small. Is that because the underlying security, the Treasury security, where haircut and margin don't seem to be a major problem? If you're talking about the derivatives where the underlying is much less liquid, like corporate bond or other securities, maybe this component will be larger.
Yeah, that's a good point. So certainly, with T-notes, we're talking about, standard 2% haircut, in the repo market. So it's like 2% of the value of the security times the incremental spread between unsecured financing and secured financing. So if that's only 25 basis points or something like that, or 100 basis points, it ends up being very small.
Exactly.
Similarly, with the margins that are required by the futures exchange, the cost of financing it, the incremental cost of financing it is quite small. It's not the total interest rate, it's the spread between secured and unsecured financing.
Exactly.
So you're right, but if it was some other
like equity
where,
or corporate bond, then probably this would be much larger.
You're right, it could be quite a bit larger.
Yeah.
But again, it's just kind of the incremental cost of financing the margin. But if the margins are on the order of 2%, it's pretty tiny.
Yeah, the second comment is related to the earlier question about long and short. So from the intuition you described, I would have thought when the intermediaries are having a long position or when they're having a short position, the implications would be the opposite in terms of the implied repo rate. Based on the evidence we have seen in the literature where like the demand-based option pricing paper, let's say Peterson, Guardiano, where they find that when the intermediaries are holding long positions, the prices tend to be lower. The implied volatility should be lower as a result. On the other hand, when the intermediaries are holding short positions, the price will be the opposite. The prices should be higher, implied volatility will be higher. I would have thought something like this would show up, but obviously it's an empirical question whether it happens there or whether there is cross-sectional variation in terms of the directions for the intermediaries. Maybe there is not much in the data.
Yeah, it's an interesting question. You know, we're just sort of taking mid-market prices. What we didn't do is to sort of, you know, stratify it by, you know, bid and ask to see if there's some asymmetry there. You would normally think long and short positions are kind of opposite, but often the way that they get impact liquidity ratios or, you know, some of the LCR, SLR types of ratios is that there's really, they're not treated any differently going long and short. We actually have a long discussion of this in the appendix to our paper.
Okay.
And it's more symmetric than it seems like it should be. And so it doesn't matter whether you go long or short, you still get hit with the same sort of impact on your capital ratios. So, but you're right, there may be some differences, some other differences that could make a distinction going long and short. So something that needs to be dug into, but some of the capital regulation now is just not making any difference between long and short positions.
Are there any estimates which shows whether the intermediaries are in aggregate taking long position or short position, or we don't know that at all?
I don't know that. I know that people have looked at the research, you know, not on the street. We were all basically, you know, we were selling American style volatility to the market and often long European vol, but that's just anecdotal. It'd be interesting to know whether the street is, you know, long or short, different types of, different sort of stuff. Like, you know, think about CDS is a street net buyer or seller of protection.
We know for options. We know for options, there's a difference, right, between index options and individuals.
Yeah, the street is basically selling vol.
Yeah. All right, thanks.
All right. Are there other questions or other comments?
Hello. I do have a question.
Yes.
Hi, I'm Lyra. So I was wondering, in extreme world, say, where investors have a demand for this U.S. Treasury, for example, and I think it relates to the convenience yield question before. But suppose that there is this demand and the funding cost is actually constant over time. Then this demand is changing, and because of this funding basis is changing. Is there space for this demand to be actually driving also this basis? And if so, how would we control for that when we're thinking about the funding cost of those positions, of the derivative positions?
Yeah, that's a good question. I think that there would be in this context, because as we've seen in sort of crises or a flight to quality or a flight to liquidity of some sort, what we see is that the Treasury collateral becomes special and you can start financing cash positions at lower rates than synthetic positions. And so I think it shows up in that will make the spread between implied repo and actual repo widen, make the basis wider. But it's because the treasuries now suddenly have the advantage that people really want them and they can finance them at lower rates.
Exactly.
Yeah. So yeah, I think your point is well taken. And sometimes there's derivatives really don't go on special, right? They're just generic. Whereas securities, since they're in physically limited supply, sometimes supply and demand pressures can move their prices around. That's one of the arguments we've had about advantages of derivatives, is that they should be less susceptible to manipulation, short corners, or sweet squeezes. But the downside of that is sometimes there's an advantage to having a cash security because it goes on special, finance it cheaply, and you lose that with a derivatives contract. So it's a two-edged sword.
Exactly, exactly. Okay, thank you.
Thank you.
Okay, any other questions?
Can I ask a quick question? Is there a difference in tax treatment between futures and the spot? Like I know futures will be 60-40 and spot will be, I don't know.
The tax treatment, they're different products, and the tax treatment depends on who owns it and how they own it. So there could potentially be differences, but I don't think it. I think it would be very specific to the investor. They're not. Yeah, they're going to be difficult to compare. That's a good point, but I don't know that in equilibrium is going to drive any
So
pricing.
can I ask a follow-up question to that, Francis?
Sure.
Maybe I'm wrong, but I had been under the impression, so I'll refer to Salomon Brothers since maybe you know there, that at least in the trading portfolio, they were taxed on mark-to-market profit and loss so that all positions would be treated symmetrically. Is that correct, or am I wrong about that?
No, you're correct that, if you're an institution, a bank, or a broker-dealer, then yeah, it's all on mark-to-market.
But only in the trading portfolio, right?
On the trading portfolio.
Yeah.
But, whether the futures is being used as a hedge, and if you're a corporation, do you get sort of hedge treatment on the position? That depends on who is holding it and what purpose. There's been a lot of changes on this over time. But yeah, it depends on who the marginal investor is. If they're some sort of hedged entity or a sovereign wealth fund that doesn't have to sort of mark to market, it could impact it. Depends on who the marginal investor is.
All right. There's probably time for one last question. Does anyone want to ask one more question? Okay, last opportunity.
Okay, well, thanks everyone. Great to be with you.
Well, thank you very much, Francis. It